Welcome to CMA USA Exam Coach. In this episode, we are moving into the final topics of Section A, Part 2, Other Topics. As of now, we have successfully covered the major portion of Section A, including a detailed discussion on financial statement analysis and ratio analysis. Now, it's time to explore the remaining key areas that complete our journey through Section A. So, what are we going to cover in this episode? Let's check it out. First, foreign currency in financial statement analysis. Second, accounting for foreign operations. Third, inflation and financial ratios. Fourth, earnings quality. Fifth, sustainable growth rate. Sixth, accounting profit versus economic profit. And lastly, the benefits and limitations of ratio analysis. Stay tuned as we walk through each of these important topics, one by one. Let's now explore the topic of foreign exchange fluctuations in more detail with simple examples. In a global business world, companies often deal with multiple currencies. Exchange rates between currencies change daily, and these changes create two main types of effects. First, foreign currency transaction gains and losses, and second, foreign currency translation differences. First, let's discuss foreign currency transactions. This happens when a company directly deals with foreign currencies, for example, buying, selling, borrowing, or lending in a currency that is not the company's functional currency. Suppose you are a US-based company and you import goods from a Chinese supplier. You agree to pay 100,000 Chinese yuan, CNY, after 30 days. At the time of the purchase, the exchange rate is 1 USD =7 CNY. You record a liability of approximately $14,285.71 in your books, 100,000 a 7. Now, after 30 days when you are about to make the payment, the exchange rate has changed. Let's say the new rate is 1 USD = 6.8 CNY. Now, to pay 100,000 CNY, you only need $14,705.88. Compare this with the earlier amount of $14,285.71. You now need more US dollars to settle the same obligation. This exchange rate change creates a foreign currency loss, which is recorded in your income statement. Similarly, if the US dollar had strengthened against the yuan, you would pay fewer dollars and recognize a foreign currency gain. In short, if the foreign currency strengthens against your home currency, you face a loss. If the foreign currency weakens, you record a gain. Now, moving to the second part, foreign currency translation. This comes into picture when you have a foreign subsidiary. Imagine your US-based company owns a subsidiary in China. The Chinese subsidiary prepares its financial statements in Chinese yuan, CNY. But when you prepare the consolidated financial statements, you must translate the subsidiary's yuan-based financials into US dollars, USD. How do we translate? Assets and liabilities are translated at the current exchange rate on the balance sheet date. Revenues and expenses are translated at the average exchange rate for the reporting period. Equity items like common stock and retained earnings are generally translated at historical rates. During this translation process, the mismatch caused by fluctuating exchange rates creates what we call foreign currency translation differences. For example, if last year the CNY to USD rate was 7, and this year it is 6.8, the values of the assets and liabilities of your subsidiary will change when reported in USD. This change does not impact the current year's net income. Instead, it is reported in the equity section of the balance sheet under a special account called Other Comprehensive Income, OCI. In short, translation differences due to foreign subsidiary financials go to OCI, not to the income statement. Summary of key points. Foreign currency transactions create gains or losses in the income statement immediately. Foreign currency translations create adjustments recorded in equity under Other Comprehensive Income, OCI. Both are important for understanding the real financial performance of international businesses. Understanding this topic is critical because companies with significant global operations can show volatile earnings or equity movements not because of business performance, but purely due to currency fluctuations. Now, let's discuss accounting for foreign operations with a practical example. When a company operates internationally, it often owns subsidiaries in different countries. For financial reporting, the parent company must consolidate all operations into one final report, usually in its own home currency. Let's understand some important terms with an example. Parent company. The parent company is based in the United States, so its reporting currency is the US, dollar USD. Subsidiary company. The subsidiary is located in Norway. In Norway, the subsidiary maintains its accounting records in Norwegian krone NOK. This is called the currency of record, the currency in which the books are maintained. Business activities. Although the subsidiary is based in Norway, its major business transactions, sales and purchases, are with companies in China. Most of the contracts, cash flows, and settlements happen in Chinese yuan, CNY. Because of this, the functional currency for the subsidiary is Chinese yuan. Now, how does the accounting work? First, remeasurement. Since the accounting records are maintained in Norwegian krone, but the functional currency is Chinese yuan, the subsidiary must first remeasure its books into Chinese yuan. This adjustment affects the income statement, and any gains or losses from remeasurement are recognized immediately in the profit and loss account. Then translation. Once the subsidiary's financials are ready in Chinese yuan, they are translated into the reporting currencies, which is the US dollar, for consolidation into the parent company's financial statements. Translation differences are not recognized in profit and loss. They are reported under other comprehensive income. In simple words, the books are kept in Norwegian krone. The business reality is in Chinese yuan, and the final reporting must happen in US dollars. Now, let's discuss inflation and its impact on financial statements. First, what is inflation? Inflation refers to the general increase in prices of goods and services over time, leading to a decrease in the purchasing power of money. In simple terms, with inflation, the same amount of money buys fewer goods and services than before. Now, how does inflation affect financial statements? When inflation is high, the historical cost recorded in financial statements becomes outdated. Let's break it down. Assets. Assets such as buildings, machinery, and inventory are recorded at their original purchase price. Due to inflation, their real market value may be much higher, but the financial statements still show the old, lower value. This leads to an understatement of the company's true asset value. Liabilities. On the other hand, liabilities such as loans remain fixed in nominal terms. With inflation, the real burden of these liabilities actually decreases because the company is repaying the loan with cheaper money. This can make companies appear stronger financially than they really are. Revenues and expenses. Revenue might increase with inflation as selling prices go up. However, if the cost of goods sold and expenses are based on older, lower costs, the profit margins might look artificially high. Loan impact. If a company has taken a loan at a fixed interest rate, inflation can benefit the borrower because they are repaying the loan with money that has lower purchasing power. Equity and retained earnings. Reported earnings might be overstated, causing retained earnings and equity to appear higher than their real economic value. Overall, inflation distorts financial ratios and makes comparisons over different periods inaccurate unless adjustments are made. In short, assets are understated, liabilities may appear less burdensome, profits might look inflated, and financial health might seem better than it actually is. That's why analysts must be cautious when interpreting financial statements during periods of high inflation. Now, let's also discuss the effect of accounting changes on financial reports. In accounting, when a company changes a policy or corrects an error, it can impact the financial statements. There are two major methods used to reflect these changes: retrospective application and prospective adjustment. First, retrospective application. This means we apply the new accounting policy to previous periods as if it had always been in place. We adjust past financial statements to show what the results would have been under the new method. This process often leads to restatement of prior period financials. For example, if a company changes the way it depreciates its assets, it needs to recalculate depreciation for earlier years and update the old financial statements. Second, prospective adjustment. Here, we apply the change from the current date forward. Past financial statements are not adjusted. Only the future financial results reflect the change. This is common when there is a change in an accounting estimate, like updating the useful life of an asset. In summary, retrospective adjust the past, restate prior periods. Prospective only impact the future, no restatement. Understanding these concepts is important because changes in accounting can affect how investors and stakeholders interpret a company's financial health. Let's look into some of the examples. First, let's talk about retrospective application. This method involves applying a change in accounting policy to previous periods. Essentially, it's as if the new policy had always been in place. For example, imagine a company decides to change its inventory accounting method from LIFO, last in, first out, to FIFO, first in, first out. With retrospective application, the company would restate its financial statements for prior periods as though FIFO had always been used, even though it was originally applying LIFO. This means the company would adjust prior year's income statements, balance sheets, and cash flow statements to reflect the change. In practice, this could impact things like inventory valuations, net income, and tax calculations, especially if the company was previously using a method like LIFO, which can result in lower profits during inflationary periods. Next, let's move on to prospective application. Unlike retrospective application, prospective application means the change is only applied to future periods. You do not restate any prior financial statements. This typically happens when a company revises estimates or judgments in its financial reporting. A good example is when a company changes its estimate for the useful life of an asset. Let's say a company decides that a piece of machinery will now last 10 years instead of the previously estimated 8 years. Under prospective application, the company would only apply this new estimate going forward, and the depreciation expense for future periods will reflect the revised useful life. The past financial statements would not be adjusted. Prospective application is also used when a company changes its accounting estimate, like an estimate for bad debts or warranty expenses, without affecting previous years. Now let's talk about restatement. Restatement occurs when a company needs to correct an error in its previous financial statements. Essentially, restatement is about fixing mistakes in earlier reports, and it requires adjusting past financial statements to reflect accurate information. For instance, if a company made an error in revenue recognition or misclassified expenses in prior years, they would have to restate the financial statements to correct those errors. The restatement ensures that the corrected financials are more accurate and reliable. The key thing to remember about restatement is that it only occurs when there are errors, whether from the application of an incorrect accounting method or other financial misstatements. To recap, here's a quick summary of the 3 accounting treatments. Retrospective application applies changes to past periods, like switching from LIFO to FIFO for inventory accounting. Prospective application only affects future periods, like changing the useful life of an asset or adjusting an estimate for bad debts. Restatement is the correction of errors in past financial statements. Understanding the difference between these methods is crucial for accurate financial reporting and making sure your financial statements reflect the most up-to-date accounting treatments. Next, we are discussing about earnings quality. Earnings quality refers to the degree to which a company's reported income truly reflects its actual financial performance. Higher earnings quality means the profits are sustainable, repeatable, and based on real economic activity. Low-quality earnings might be inflated temporarily by using aggressive accounting methods or one-time events, and they are not sustainable. There are several important factors that influence earnings quality. First, the business environment. The nature of the industry and the overall economy can impact earnings quality. Companies in highly cyclical industries like construction or automobiles might face pressure to smooth out earnings during downturns. Companies in stable industries like utilities often have more predictable and higher quality earnings. Second, the selection and application of accounting principles. Management's choice of accounting methods significantly impacts reported earnings. Conservative accounting recognizes expenses earlier and revenues later, creating a more cautious and reliable picture. Aggressive accounting recognizes revenues sooner and delays expenses, making profits look better in the short term, but reducing earnings quality. For example, if a company expenses research and development costs immediately, it is applying a conservative policy. If another company capitalizes research costs and amortizes them over many years, it is using an aggressive policy that inflates current profits. Third, the character of management. The ethical behavior and intentions of management are critical for earnings quality. Sometimes management may manipulate earnings to meet targets or earn bonuses. For example, a company might postpone necessary repairs to the next year to avoid recognizing a large expense in the current year. Or they might delay launching a new advertising campaign to reduce this year's marketing expenses. These tactics make the current year's earnings appear stronger, but they are not sustainable and will likely create problems in future periods. In summary, earnings quality is higher when reported profits closely match real economic performance, conservative accounting policies are used, and management acts ethically without manipulating financial results. Next, we are discussing about sustainable growth rate. Sustainable growth rate, or SGR, represents the maximum rate at which a company can grow its sales, earnings, and dividends without having to increase financial leverage or issue new equity. It shows how much a company can expand using only its internally generated resources. The equation to calculate the sustainable growth rate is sustainable growth rate equals 1 minus dividend payout ratio multiplied by return on common equity, where return on common equity, or ROCE, is calculated as net income available to common shareholders divided by common shareholders' equity. Dividend payout ratio is calculated as dividends declared divided by net income. Let's see a simple calculation. Suppose a company has a return on common equity of 15% and a dividend payout ratio of 40%. First, calculate 1 minus the dividend payout ratio. 1 minus 0.40 equals 0.60. Now, apply the sustainable growth rate formula. SGR equals 0.60 multiplied by 15%, which equals 9%. This means the company can grow its sales, earnings, and dividends at a sustainable rate of 9% annually without taking on new debt or issuing more shares. Interpreting the sustainable growth rate. If a company's actual growth rate is higher than the sustainable growth rate, it might need external financing to support that growth, such as new debt or equity. If the actual growth rate is lower than the sustainable growth rate, the company may have unused capacity to grow further or may be generating excess cash. Understanding the sustainable growth rate helps managers, investors, and analysts evaluate how aggressively a company can pursue growth while maintaining financial stability. In CMA exam questions, dividend payout ratio and return on common equity may not be given directly. You may have to calculate dividend payout ratio and calculate ROCEs separately before applying them into the SGR formula. Next, we are discussing about accounting profit and economic profit. Before that, let's understand explicit costs and implicit costs. Explicit costs are the actual out-of-pocket expenses a business pays in the course of its operations. These include payments for wages, rent, utilities, materials, and other direct costs. Explicit costs are recorded in the company's accounting records and financial statements. Implicit costs, on the other hand, are the opportunity costs of using resources already owned by the business. These costs are not directly paid out in cash and are not recorded in financial statements. Instead, they represent the income that could have been earned if the resources were used differently. For example, if a business owner uses a building they own for their shop, there is no rental payment made. However, the rental income they could have earned by leasing that building to someone else is an implicit cost. Similarly, if an owner spends time managing the business instead of working elsewhere for a salary, the foregone salary is also an implicit cost. Now, let's move to accounting profit and economic profit. Accounting profit is calculated by subtracting total explicit costs from total revenues. It only considers the actual expenses paid and is the profit figure reported in the financial statements. Economic profit is calculated by subtracting both explicit costs and implicit costs from total revenues. It gives a more complete picture of profitability by considering opportunity costs. Let's see a simple example. Suppose a business earns total revenues of $100,000. Explicit costs such as rent, salaries, and materials amount to $70,000. First, calculate accounting profit. $100,000 minus $70,000 equals $30,000. Now, assume the business owner gave up a job opportunity that would have paid $10,000. This $10,000 is the implicit cost. To calculate economic profit, take the accounting profit of $30,000 and subtract the implicit cost of $10,000. Economic profit equals $20,000. In summary, accounting profit equals revenues minus explicit costs. Economic profit equals revenues minus explicit costs minus implicit costs. Accounting profit measures financial performance based on actual cash expenses, while economic profit measures true economic value by considering both explicit and implicit costs. Now that we have learned about various types of financial ratios, such as liquidity ratios like current ratio, market ratios, profitability ratios, and many others, We can understand how these ratios help businesses, investors, and stakeholders assess a company's financial health, performance, and future potential. Ratios provide valuable insights by simplifying financial data, helping in comparisons, and supporting better decision-making. However, while ratios are very useful, it is important to recognize that they also have certain limitations. Now, we are going to discuss the benefits and limitations of ratio analysis. Ratio analysis is a powerful tool that helps in evaluating a company's financial performance and comparing it over time or with other companies. However, it also has some limitations that must be understood. Let's first discuss the benefits of ratio analysis. First, simplifies financial information. Ratios condense complex financial statements into simple, understandable numbers that are easier to interpret and communicate. Second, helps in comparison. Ratios enable comparison between companies of different sizes and industries and allow trend analysis over different time periods. Third, aids decision-making. Investors, creditors, and management use ratios to make informed decisions about investing, lending, and managing the business. Fourth, identifies strengths and weaknesses. Ratio analysis can highlight areas where the company is performing well and areas that may need improvement. Fifth, useful for planning and forecasting. Ratios help management in budgeting, planning, and predicting future financial needs and performance. Now, let's discuss the limitations of ratio analysis. First, depends on reliable data. Ratios are only as good as the quality and accuracy of the financial statements they are based on. Manipulated or outdated data can give misleading results. Second, ignores qualitative factors. Ratios focus only on numbers and do not capture non-financial aspects like employee satisfaction, management quality, or brand reputation. Third, affected by accounting policies. Different accounting methods, such as inventory valuation methods or depreciation techniques, can distort ratio comparisons between companies. Fourth, difficulties in comparing across industries. Companies in different industries operate under different conditions, making cross-industry ratio comparisons less meaningful. Fifth, historical focus. Ratio analysis is based on historical financial data and may not accurately predict future performance, especially in a rapidly changing business environment. In summary, while ratio analysis is a valuable tool for financial evaluation, it should be used carefully alongside other methods and professional judgment to form a complete understanding of a company's performance. Thanks for watching! We are winding up our Section A from Part 2. Remember, study well and focus on understanding the core concepts. This presentation covered the main points, but make sure to read your textbook for more detailed explanations and additional topics we may not have covered. If there's anything we missed, or if you need more clarity, be sure to revisit the material and practice as much as you can. Don't forget to practice the questions from your support pack. It's key to reinforcing your learning and building confidence. Keep pushing forward, stay motivated, and trust in your preparation. You've got this.